Hey, greetings. Keith Prather here with another NCM update. And this is the one that we're going to cover the macroeconomic environment. So I want to dive right in. It's been a very interesting Q3 and Q4 as we kind of get into the end of the year and start looking into 2026. Uh, as I'm recording this morning, we just got the latest GDP report from Q3, and it came in a lot hotter than expected. It came in at 4.3% growth. We'd been tracking it all quarter. It looked like it was coming in a little bit hotter than expected at about 3.5%. 4.3 was off the charts. And I think what's critical for NCM members, regardless of what part of the spectrum we're in, whether it's automotive, power sports, marine, farming, doesn't matter. We saw really good consumer spending signals. We also saw good corporate spending and corporate investment signals. And overall, just got a pretty solid reading for Q3. Now that data lags, right? So we're still kind of getting into Q4. We've got the noise of the government shutdown for Q4, and we think that probably brings Q4 in a little bit softer than expected. And there's some other concerns that we have out there, a little bit of on the consumer front, and some of what we're seeing with consumer debt, and some of the wherewithal and the spending capacity that they have. We'll talk more about that in a moment, but I wanted to point really quickly to the Fed's announcement earlier in December with interest rates and then what they're projecting for 2026. So as you all know, they cut 25 basis points off of the Fed effective funds rate. This really controls short-term borrowing, mostly for credit cards. Doesn't affect us as much for longer-term loans, 5 to 7 years for automotive. And then marine, we get into a lot longer terms of loans. And because of that, those are tied more to treasuries. So we'll see the US 2 year, 5 year, 10-year treasuries driving more of NCM product sales, if you will. So what the Fed is showing us then essentially is for 2026, a surprise when it comes to GDP and the outlook. In September, they really felt that 2026 was going to come in at only 1.8% growth. That's pretty average. If we go back over the last decade, going all the way back to the financial crisis, 2% was that average range that an economy our size is probably going to generate. But they've increased that forecast to about 2.3%. Now, part of where that's coming from is also important to NCM members. Number one, they're expecting consumer spending to pick up because of unrealized or unexpected rebates from the tax bill. So we're going to see refunds from the federal government be much higher than expected. The average household in the U.S. probably realizing somewhere between $1,500 and $2,500 more in tax refunds than they got a year ago. For many households, they don't even understand what's in the tax bill. There's been so much negative media about it that once they get into Q1, they're going to feel that. And then we think we'll start to feel it in consumer spending in Q2, even in the durable goods categories, especially power sports and some of our NCM categories that have lower price points. I think the biggest difference will happen, especially in the power sports arena. I think you'll see some nice growth there. The other thing is the Federal Reserve on their new forecast has still got unemployment pretty low. They've got inflation somewhat tame. We are expecting a little more pressure maybe in Q1, but generally inflation comes back down closer to the Fed's 2% range. And what they're projecting for 26 is probably one more quarter point cut. I've seen a lot of Wall Street forecasts out there that are calling for maybe two quarter point cuts next year, but at least count on one more. There's no forecast out there showing interest rates going the wrong direction and increasing. So that's at least a good signal. A couple more things I want to show you on the inflation front. We look at average inflation, and earlier in April this year, we saw it about 2.7%. The most recent data we have through September was about 2.5. And we think based on the latest inflation data that we've gotten, it probably will stay at about this range, probably headed into Q1. You see it on a 12-month basis. We see it, going from 2.6 to maybe 2.7%. So that 2.7 to 2.8 range is probably what to expect. The big news out of that is that we don't see that massive tariff inflation surge that we were worried about. The second thing is that this data, as long as it stays stable or decelerates a little bit, will keep the Fed in play, and the Fed will continue to pull interest rates lower. What we're really watching, though, as I said earlier on, is the 10-year Treasury. At the time I was recording this, it was running right about 4.11%. I want you to watch this because as we're talking to clients and as we're talking to folks, 4% becomes a very psychological threshold. Once the 10-year Treasury goes below 4% and it sticks there, okay, it's got to stay there, we'll start to see more consumers coming back into the mix, refinancing their mortgages. And as they refinance their mortgages, we typically will see the average household free up $100 to $200 a month. So whether we're buying an automobile and we're thinking about whether we can take on more of that monthly debt, being able to refinance is going to be critical to bring a bunch of households back into the buyer mix. The other key threshold is 3.5%, and at 3.5%, if the U.S. 10-year Treasury can get down to that rate, and we've seen it much lower than that, in prior cycles, that would then usher in what we think is a new home building cycle, which creates GDP acceleration. It creates job growth. It's sort of like the tide that lifts all ships. You see everything kind of come up at the same time. And with that, we would see sales across all NCM categories, including farming and ag, improve overall. So marine, power sports, what we see in the automotive sector, farm equipment, and even RV sales would all improve based on hitting that 3.5% signal. So I just want you to keep those two things in mind. I mean, we're going to continue to update you this on a monthly basis, and I'm going to keep going back to this. I'm going to give you an update of where we're sitting in the 10-year Treasury. But remember, 4% is that first psychological threshold. That spurs activity, and then 3.5 is the big trigger that then creates a lot of growth. Small businesses are about 50% of GDP. They're big buyers, especially fleet buyers at a local level. So a lot of dealerships and automotive are going to be really need to pay attention to what small businesses are looking at. And small businesses are generally pulling back on investment, right? They're not spending like they were. But what we have to do is really peel back layers of the onion to really figure out what would spur them to go out and spend, right? What's that trigger that gets them back in the market? And I just spent a lot of time talking about interest rates, and it really matters to consumers. But for small businesses, that's not their biggest concern. Only 3% of all small businesses think now is a bad time to invest and spend based solely on interest rates and what's happening in the financial markets. 2% are uncertain. Everybody else is like, that doesn't matter to me. The big factors are overall economic conditions. So they're going to watch that. 26% believe that economic conditions are weak enough that they're not going to go out, they're not going to invest, they're not going to spend. 15% are uncertain. 4% think it's a great time to go invest. The other one is a political climate. And by political climate, what we mean is they're worried about trade policy. And if the trade policy cools down, if we don't see that rhetoric as much in the press, you'll see small businesses get a little more confident and a little more comfortable, and they'll go out and they'll spend and they'll invest and they'll take some chances and they'll take on some risk. I just want to point that out because these two elements, the economic condition piece and the political climate piece, are areas that the Trump administration is going to work hard on in Q1 and Q2 because they want to build the economic momentum and the political momentum going into midterms next year. So watch for those two items to improve, which if they do, would bring small business sentiment sort of back down to levels where we should see it, or back up to levels where we should see it. And that should spur economic growth and expansion and acceleration. So the other thing that they're worried about over laying awake overnight, as they're laying in bed and they're trying to figure out, what's on their radar. Labor quality is number one. We don't see that improving. It's very systemic. It's very difficult to improve labor quality. But inflation we know is controllable, and we know inflation is coming down a little bit. So we think that will improve their sentiment. Taxes, there's no tax bill reaction yet, but we believe that once they start filing their taxes in Q1, small business owners will also feel the benefits from the tax bill, and we think that that lifts that fear off of their plates. Government regulations we know are easing. We're still seeing more and more regulations coming down and making the operating environment easier, but we can't control insurance costs. Insurance costs continue to go up. It's going to continue to be a factor. There's no swipe of the pen from the federal government that can really fix that overnight. That's going to continue to be a factor. And then lastly, interest rates, even though they're tied for last as among those items that really keep business owners awake at night, um, it's one of those items that we can control. So again, out of the top five things that are keeping business owners up at night, I just want you to realize that at least four of those are controllable. The other one, and then half of this government regulation insurance cost piece are a little more systemic. They're a little harder to fix. They take longer. But if those other four were out of the way, I think you would see a surge in spending. The reason why I bring a lot of this up is because, as you know, we do a lot of economic modeling and we produce a lot of these proprietary models for NCM. And what we're seeing are a couple of things here. We're seeing a Q2 surge, and if you don't watch this video, but if you go watch all the individual videos, you're going to see that I've got this particular model in every one of the sectors. It's because it's so important. A couple things that I watch on these models. Number one, obviously the trajectory is upward and we see a good solid growth rate, but it stays in that historic range, right? We don't see a super surge in spending. We don't see anything out of the ordinary at the moment in the model. The other thing is, though, these two bars, so the upper end bar and the lower end bar, are what we call like the range of possibilities or cone of variability, we call it. We run 1,000 different simulations to create that upper bound and that lower bound. And typically what I'm looking for is a bottom curve here that if all of the worst case scenarios happened, if we saw, within reason, if we saw, interest rates go the wrong direction, if we saw the Federal Reserve um, come in and move in the opposite direction of freeing up markets but continue to tighten markets, if we saw something happen geopolitically that would create a problem for the US dollar, when we paint those scenarios into the model, right now we're getting a curve that still looks like it's going to jog sideways. So if we're worried about risk, especially at a consumer level, what we're getting out of this curve is a fairly modest risk environment moving forward over the next year and spilling out into 2027. Again, if the curve were like this, if it were looking downward, that would be a recessionary risk curve. And we're not getting that out of the scenarios right now. Again, this is 1,000 simulations against this model to try and figure out where conditions would go. And we believe that the output's going to fall somewhere between these two. So there again, not a lot of downside risk on the consumer front, which is great for every single NCM market. Non-residential construction, then we've got a little bit of a jogging sideways. So if you're into fleet sales and you do a lot of fleet sales to construction workers, note that Q2 is probably where your biggest opportunities are going to come back into the fold. Most of the models that we've got are showing this, what we're calling a Q2 pop, and we're getting that acceleration and then it carries out through the end of the year. So this is going to be data center construction, power generation. It's going to be a lot of sectors. If you're in any of the southern states, spanning all the way from Arizona to Florida, and if you're up in the upper Ohio Valley, maybe a little bit of the Tennessee Valley area, you're going to continue to see similar growth curves. And that stretches all the way to the Carolinas, a little bit south of that as well. Um, that's a strong growth curve, but we're still waiting on a few catalysts to really see it take off. And the downside risk on this is a little bit greater than what we saw, obviously, in the retail spending one. For residential, then, for the first time, perhaps maybe in 2 or 3 years, you could see the residential markets improve. And again, the residential housing market can contribute as much as 16% of GDP. So what happens in the housing market is critical for what happens across the rest of the economy, and especially for the consumer markets that feed NCM. So we're watching that. The National Association of Realtors has a similar forecast out. They're projecting 5% growth in 2026 for new home sales and 14% growth in existing home sales. So that's primarily what I had for you this quarter from a macroeconomic perspective. We're going to be watching a lot of things. We will be probably kicking the next video and the next series of briefing updates out a little bit earlier in January. We're going to get back on the cycle. Government shutdown and data lags really created some havoc on the data, which is why this particular update is so late in the month. But we'll get back on cycle as we get into Q1 and we get back into a regular cadence and getting government data and getting it out accurately. So that'll help us overall. We'll get back on cycle probably in January. So we hope everyone is doing well, and we look forward to seeing you again next month. Have a Merry Christmas and a Happy New Year, and stay safe over the holiday season. We'll see you soon. All right, take care. Bye bye.